So the RBA has decided to leave rates on hold in September, pretty much in line with expectations. But this is a really interesting statement for me, and this is a really important time in the cycle. And I want to spend a few minutes today talking through what I believe is going to be a really, really profound period in the Australian property market. How did we get here? So after COVID, after the pandemic, there was a period of uncertainty for central banks whether inflation was transitory or inflation was actually staying around. They're a little bit late to the game, but they figured out early last year, early 2022, late 2021, that inflation wasn't transitory, it was persistent, and they had to move. So then they started moving, and they knew they were behind the curve. They moved very aggressively. They've now moved to a point where they weren't sure where they were going to stop, but it feels like now they've reached that point. So we're moving from a raising period into a period of holding. So to me, this statement reaffirms that the RBA in Australia and also the US Fed soon is holding. They're moving into the holding pattern. And there's a few glimpses here, particularly towards this section where they're talking about uncertainty, they're talking about things slowing down, they're acknowledging that people are spending less money, and they're basically now making the case for the hold. They made the case for the rise last year, late last year, beginning this year, they made the case for the rise. Inflation was too high, the jobs market was too strong. They're now making the case for the hold, that despite inflation still being high and above where they want it to be, there are things starting to slow down. So there are offsetting factors for them. So to me, that's really, really important. Another important part in this statement, and I think this is really important for any investor that's considering their real estate decisions. The last section, again, nothing new, kind of in line with what they've been saying, but the second part of the first sentence is really important to me. So some further tightening of monetary policy may be required to ensure that inflation returns to a target in a reasonable time frame, but that will continue to depend on the data and the evolving assessment of risks. So they're saying that they could put interest rates up again. They might put interest rates up again, but that depends on data. The recent data has been showing that inflation is coming down, that the jobs market is softening, people are starting to spend less, and the evolving assessment of risks. They're very mindful that they're going to cause cracks by increasing rates so aggressively, and a lot of those cracks may have not emerged yet, but may emerge over the next 6 to 12 months. So every central bank needs to basically back its talk up with action. They need to maintain credibility. They need to ensure that if they said they were going to tackle inflation, they do it. They're not running away from that. But they are also, so that's first and foremost. They're always going to say, look, inflation is important. We have to target it. That's what we're going to do. And again, that's the last sentence. The board remains resolute in its determination to return inflation to target, and will do what is necessary to achieve that. The thing is, they've done, at this point, September 2023, they've already done a lot. They've already done what I believe is necessary to achieve it. They can continue to go more, but that'll have costs. Every action has a reaction, and they're trying to balance it out. They're trying to bring inflation back without breaking the system. So what does this mean? It means we are now in a holding pattern. The way that the Aussie dollar is trading against the US dollar is confirming that to me. The Aussie dollar remains very weak, and that is because the markets are looking and seeing Aussie rates unlikely to rise. The US is still trying to figure out where it's going, but Australia has kind of made its mind up that it's on hold. Unless inflation breaks out, which it's unlikely to do so because the impact of recent rate rises is still to be felt through the market. I think we're on hold. I think the economy continues to slow down. I think services continue to soften, spending continues to soften, the unemployment rate starts to inch to 4%, perhaps in the low fours. And next year, it's a different picture. Next year, the pain is going to start being felt, and the wording of these statements, new governor coming in, new reality, and I think the narrative starts to change next year. Hold from mid 2023 to the end of 2023. They start 2024 late, and when they do, I think first quarter, second quarter 2024, the narrative starts to change. Now, if you're investing in markets, markets move before central banks do. So the real estate market moves before central banks move. The stock market moves before central banks do. And I think what we saw this year and what we saw in the past couple of months is the market starting to move because investors are taking the view that rates have probably peaked, and they're probably right. This statement tends to confirm that.